Welcome back to the Covered Call Masterclass. My name is Stephen Cox. I'm a full-time options and futures trader, and I'm the CEO of Share Navigator. So this is video number 2 of the Covered Call course. In the first video, we covered what a covered call is, how you establish what your break-even point, your profit and loss, how you would set up the trade, and we used an example with NVIDIA. Today, we're going to discuss how you can maximize your yield by changing from weekly to monthly expiries. And we'll also discuss a little bit more about strike prices. But if you would like a more in-depth view of the covered call strategy, please visit our website, click on our option strategy courses, and you can access our free covered call course. If you would prefer to stay on YouTube, we also have a courses section on our YouTube channel. And finally, if you like this video, please like and subscribe. It really does encourage us to provide more free content on YouTube. Let's get started. So let's start with the first question you should be asking yourself if you're going to sell a covered call. What expiry should I pick? Should it be weekly call options or monthly call options? So the monthly approach is usually 30 to 60 days away. That's usually what people do, is about a 40, 45 day call option. The benefit of that is you're getting a higher premium in, you have more time to manage the trade, and you have a less gamma risk. Now, we'll discuss gamma again later on, so we're not going to confuse you now. The negative side of the monthly approach is your capital technically is tied up for longer, although it's not a reasonable argument because you're going to hold the shares anyway till you hit your target price. And then the time decay on the option is a little bit slower than the weekly options. And again, we're going to discuss theta later on in the video. A weekly approach will be considered anything from now up to 2 weeks, for example. And the benefit of that is the time decay is working at its quickest. So the value of that option is eroding at its quickest pace. The downside is you're generating less premium and your gamma risk is at the highest. So we're going to show you now with 2 actual option quotes, and you can see clearly the difference. So look at the premium you're generating here for the 45-day call. So your monthly call on NVIDIA here, it's $825 a contract for the 215 strike. But now look at the premium on offer for the 10-day call option, which would be considered a weekly strike. You can see at the 215 strike, we're only generating in 137. So it's a big difference. And the big difference is the time to expiration. Now, one could argue you could place 4 of these trades, the shorter term trades, for the same length of time as the monthly one. So 4 times 137 will bring you in about 520, but it's still lower than the premium you're getting for the monthly calls. So should you choose weekly or monthly? And that really depends on what your goal is. And everybody will be different here. For somebody who wants less management and more conservative income, choose your monthly covered calls. For an active trader who has got time to monitor the positions, then maybe the weekly calls are the way for you to go. But everybody is different and you will make your own mind up. Is the premium and the lack of effort more important to you, or are you happy to actively trade? And only you can decide that. So now that you've decided what expiry you're going to pick, now you have to ask yourself, well, what strike price am I going to pick? And with covered calls, usually you're going to choose either an at the money or the out of the money strike. So an out of the money strike is when the strike price is above the current share price. And in our NVIDIA example, we chose the $215 call. So remember, NVIDIA was trading at about 203 when we did this particular trade, or $204. So the strike price was $11 out of the money. And when you pick out of the money and strike prices, it prioritizes you keeping your shares and generating income. Your income will be smaller, but you've got greater potential for the capital gain on the share price. So there's a trade-off to be had there. And it really boils back to, what target price do you think NVIDIA is going to get to? So an at-the-money strike is when the strike price is at roughly nearly the exact same as the share price. So in this situation, we would choose the $204 call. So this would maximize immediate income. So you're going to get paid more premium for selling an at-the-money call versus an out-of-the-money call. However, there's a much higher chance of you losing your shares, as long as you're okay with that. So the benefit is your income is higher than the out-of-the-money call, but you've got lower potential capital gain. Remember, if you choose the 215 strike, the share price can rise another $11, so you're benefiting from that. Whereas if you choose the 204 strike, you're really selling the shares where they're at now, and the only thing you're benefiting from then is the premium. So again, these are trade-offs you're going to make. Let's have a look at the quote screen. So just looking at your quote screen again, look at the 215 call, you will get in 825. But if we pick the 210 strike, for example, you get in 1020. But again, you're lowering your strike price, which means your capital gain will be lower if you chose the 210. But on the flip side of that, you're generating more premium. So these again are the trade-offs that you're going to have to make. But in our view, really the strike price should be dictated by your target price for selling the stock. Just ask yourself the question, what share price would I be happy selling NVIDIA at? And that should be the strike that you pick. So here are some rules of thumb for picking your strike price. If you want to hold on to your shares for longer, pick out of the money strikes. If you're happy to sell now and you want higher income, sell at the money strike price. But don't underestimate the importance of psychology. And what we mean by this is, so many times people sell covered calls and then the share price rallies above their covered call and then they feel dejected. Remember, always choose the strike that you're happy to sell the shares at. And remember, you were going to sell them at that price anyway. So you should be delighted you got an extra premium in. You shouldn't be upset the fact that the share price has risen above your strike price. Too many people try and time markets, which is virtually impossible. You're not going to be any different. Be happy with your gains. So that's it for picking your days to expiration and your strike prices for the covered call. Both work in terms of being monthly or weekly, but if you're a beginner, maybe stick with the monthly covered call options. And just to remind you, we offer a mentoring service where we work with you one-to-one. If you'd like to take a free mentoring class with me, go to our website. You will see a link there and you can book a web meeting with me, and I'll be more than happy to have a conversation with you for about 30 minutes. In our next episode, we're going to focus in on actually how the mechanics of placing the trade on an online broker and how to manage the trade on an ongoing basis.
Are you a frustrated options or futures trader?
That's why we built the options trading roadmap you need. Stop relying on fragmented clips. The next step is a structured program. We start with the foundations, from the exact definition of a put to the role of delta and theta. But unlike simple videos, we provide the full learning environment. Every key strategy is supported by text, video, quizzes, and live examples, so you can test your knowledge and see exactly how it works in the market. This structured approach takes you from beginner concepts to a confident understanding of basic to intermediate options strategies, and it's 100% free.
Visit www.sharenavigator.ie. Click on Options Courses from the menu. They are all free.